when does refinancing first actually make sense?
Basically, if there isn't enough equity with your current lender due to a lower valuation, so we'll look at alternative lenders and get that equity released. If your rate with your current lender is a lot higher than what it should be and it's affecting servicing for your next move, then definitely time to consider. If policy doesn't work in your favor with your current lender, then definitely worth checking. Like usually people who go from PYG to self-employed or self-employed to a company and then
Hi everyone, and welcome back to another episode of the Brokers Lounge. Today we're going to be talking pretty much around a strategy with regards to refinancing, and it's more around the timing of when you do a refinance and some of the tricks, the trades, the pitfalls, the positives, the negatives and stuff like that. But before I do, a very big warm welcome to my esteemed colleague, Eddie. How are you, mate?
Thank you. I'm blushing.
Sorry, should I have done the drum roll?
No, that's all right.
Drum roll. So
Yeah.
I should really do a drum roll.
I'll be all right.
I'm bringing a drum kit one day.
Yeah, I'm good, mate. I'm good. We're 3 months into the new year, and it's been a very interesting and a very quick beginning as well. Like there's a lot happening in the market.
Yes.
Nationally and internationally, and it's been good. It's been good on a personal level.
Yeah. Not so good on the global front, that's for sure. So
Yeah, but
lots playing out.
we just try to stick to our business and mind our business, and hopefully, things improve. That's all we can do, right?
Yeah, exactly right. Yeah.
But how are you doing?
I'm doing very well.
Yeah.
Yes.
Yeah, you've got a big party coming up.
A very big party. So I'm off to a boys' weekend away this weekend. So
This man is wild.
for the future son-in-law's Bucks weekend. So
Nice.
I'll be in bed by 9 p.m. I promise that.
Right.
I can almost guarantee that, actually. So we'll see how we go. And then, I think 3 weeks to go until my daughter's wedding. So
There you go.
yeah, it's come around real quick. I think the first time I started looking at it, like a countdown how many days to go, was like 380 odd days to go.
Mate,
Now we're 3 weeks out. So it's come about very quickly.
You know what? About time. Because pretty much since you've started, it's like you've been planning for the wedding since you started. It's been like 2 hours and 2 years in the making. So,
I definitely feel like it, that's for sure. Yes.
All right.
Anyway, all right, so let's jump into it. So, like I said earlier on, we're just going to be talking about a strategy that, can often sound quite logical, but it can also backfire if it's handled poorly and, with regards to refinancing before you buy your next property. We see it quite often where people will say, let's refinance now, get a better rate, maybe pull out some equity, and then I'll buy a property later on. So, and quite often that actually can work quite well. But you've got to really look at all the downsides to that as well, because every person's situation is quite different as well. So today we're just going to unpack, when refinancing first does make sense, and obviously when it doesn't, and how timing can protect or conversely damage your buying position. So
There you go.
I'll hand it over to you, mate, to kick it off.
Yeah, so one of the key, I guess, moments where people look at refinancing is before they're buying a second property.
Mm-hmm.
So this is something we do quite a bit, and usually a lot of refinances happen when people are getting ready to buy another property. And there's a few, requirements or need to get the refinance done when you're getting a purchase done, mainly to access the equity in the existing property. So we refinance after getting a few valuations done, try to max out the equity that we can access from the existing property. And to be able to do that, we need to get a refinance done. And sometimes we do it with the lender, the current lender is, whoever holds the property, or we have to move it somewhere with better policy or better valuation to get the maximum equity out. Also sometimes to improve interest rate and improve servicing or borrowing capacity for the client. And also this really is a case by case, and it comes down to the client's circumstances. If their plan is to maximize the purchase power, to maximize their property portfolio, purchase as many properties, and they've got a long-term plan, sometimes refinancing, extending the term back to 30 years will improve their servicing capacity and then get the equity out and then purchase another property. Obviously, there is risk involved with that if you keep doing it and keep extending your term back to 30 years with no plan. But investors mainly who have a plan in place usually keep doing that because they know they're going to get to a stage where they will sell a few properties, consolidate and pay off the debt. So if you have a plan, it's not as risky. But if you're just doing it for the sake of borrowing more with no plan in place, then it can be an issue.
You don't want to be 60 years of age and still have a 28-year loan term.
Exactly.
It ain't going to end too well.
Well, yeah, we'll make your last payment when you're 89 and I'll see you later. And and another one basically is when people are looking to consolidate existing debts to improve their borrowing capacity as well, and they might have a couple car loans here and there and a few credit cards, and they just do a big cleanup, and that will improve capacity by a fair bit. So, but obviously this has to be done in a calculated way and knowingly understand where you stand, what happens when you extend your term back to 30 years, when you refinance and consolidate bad debts into your property and extend that term over 30 years as well. So you really need to have a plan. You really need to be working towards a better outcome in the long term rather than a short, immediate relief, right?
Yep.
So there's always a way of doing it. You just need to know what way suits you best. So yeah, that's part of it.
Very good.
Right.
Yeah. So, I know for some people this might sound like we're preaching really to the converter, but we really want people to understand that when you do refinance with another lender, they're going to reassess absolutely everything. This is not just you've been paying it for the past 10 years,
or the same lender.
Yeah, exactly right. Yeah. So it's they're going to go through the full reassessment. They're going to look at your income all over again. They're going to need updated documents. Look at your employment stability as well, living expenses, all your existing liabilities as well. They'll look at your credit file again, and that's obviously one of the big things as well. If you're doing lots of refinances or doing lots of inquiries, it's going to come up under someone's radar, and they're also going to do the servicing under current assessment rate. So, as we've spoken about in the past, the current assessment rates are typically what the actual rate is, plus a 3% buffer as well. So you may have got your loan previously when rates were, 2%. So a 3% buffer means it was assessed at 5. Now we're looking at rates in the 5s, plus a 3% buffer. So the assessment rate is going to be in the 8s. So it's important to understand that you're essentially reapplying from scratch. But when you're looking at refinancing and drawing out equity for a property purchase in, say, the next 2 to 3 months' time, some of the things that the lenders are going to see is that there's potentially a new mortgage there, a larger mortgage, another credit inquiry. Now, by all means, I don't want these to sound like probably a negative thing as well, because if it's done, like I said, in the correct way, and then it won't actually be an issue as such. So, but you just need to keep that in mind, that if the timeframes do shift quite dramatically, then you need to be aware of that. So, and I think we'll probably talk about this a little bit later on, but it's all about, if you're looking to draw out equity to purchase another property, that your strategy is also looking at that, say, a pre-approval at the same time, so that you're doing the assessment based on, okay, what's my end position going to look like? Not just the refinance plus the equity release. What about when I find a property and this is what the purchase price may look like? Am I going to be able to afford all that debt? And it's obviously some of that's based on assumptions as well. But it's important that you do that right from the beginning, not do the refinance and the equity release now and then worry about the rest later on, because it'll probably
Yeah.
bite you on the backside very quickly. So
Absolutely.
and it's something we do quite regularly. I
Yep.
know, when you're talking to clients, you're going through, this is what the imposition is going to look like, and you need to be really comfortable so that if interest rates do shift, it's going to be in line with everything that the client's looking to do as well. So,
And I think a few important things to note here is if you're refinancing, whether you're taking out equity, whether you're taking out $5,000 or $500,000, the same documents, same requirements, same assessment is done. So, and regardless of what the LVR is or how much your property is worth, it doesn't matter. So because I have that chat with many people where, my property is worth $3 million and I'm only owing 500,000. So why do they need to see this? And why
are they asking so many questions?
Yeah, because it's your income that services the debt, not the value of the asset. And obviously no bank wants to get to the stage where they're taking your asset away and selling, right? So yeah, it's just, I think, important to understand those. Now, I guess it's important to, like we touched on, the risk of servicing when you take out equity. And a few things to also be mindful about. If you're taking equity out to get a purchase done, it's always recommended to get those done at the same time and work around the buffers and leave a bit of buffer in there. Because if you take equity out and you don't have a purchase lined up, and then you just leave that money sitting in the offset account, and then you're like getting yourself ready to purchase, and that's something happens all the time. It's not an issue. It's just you need to be mindful. If rates go up, then your borrowing capacity is affected. If there's a policy change, then your borrowing capacity can be affected. If you take on any extra debt, you buy a car, you finance a car, you get, I don't know, credit card or a personal loan or whatever, this can affect your borrowing capacity. So if you had taken equity out on the basis of purchasing the property for X amount, and then you went out and you did a car loan, or you got a car loan, then that purchasing might be affected if there isn't enough buffer, and you try and get a pre-approval done and you can't get the funds needed. So you might need to use some of that equity to cover the gap, cover the bridge that you've just created with your servicing, and you might fall short, and then the equity that you've done and the plan you've had might fail, basically. So it's highly recommended that if you're going through the process of releasing equity, buying a property, not to get any extra debt, not to do any inquiries, just keep doing what you're doing, keep your employment and income steady, and just keep going until you have purchased and settled on that property before you try and do something else. So I guess the key component here is being intentional about what your plan is and what you're trying to do, and make it align. And obviously working with people like us or your mortgage broker, then they should be able to cover these points so you avoid any issues.
Yeah, because obviously a lot can change in over a period of time. Yeah. It's we're not just talking interest rates either. There's other things that banks take into consideration that can change. Things like living expenses.
Recent example, like trust lending, right? Like if you had taken equity planning on buying a property in your trust, and then policy changed, that leaves you with minimal options, and some of those options are more expensive, and then all of a sudden you cannot service what you were hoping to get. So living expenses is another option, another example.
And then the banks may have other policy changes as well. You may, and I think it's one of the things when we're looking at servicing for clients that, like you said, you do need to have a little bit of a buffer there, and not really scrape the bottom of the barrel to the point where if they do end up purchasing 3 or 4 months later, and if things have changed, they're not putting themselves in a position where they can no longer get the finance. So I don't know, the interest rates have buffers attached to them, but there's other factors that get taken into consideration. Like I said, if policy changes and say you're relying on a lot of overtime or bonuses, and all of a sudden the banks decide that they don't want to, or they want to shade bonuses a lot more than what they do at the moment, whatever it might be,
Yeah.
you can fall into a little bit of difficulty there.
That takes us, I guess, to credit file and inquiries and how they can affect you.
Yeah, so every time you do a refinance, it does trigger a credit inquiry. First and foremost, the credit files do have quite a bit on there, and I'd suggest that if you haven't looked at a credit file, your own personal credit file, probably a good idea to have a look at it so you see what information is actually on there. It's all part of open banking at the end of the day, and what we can see, the banks can definitely all see, that's for sure. But it's all about showing the repayment history of all your loans over the course of time, credit cards, personal loans, car loans, whatever it might be. It shows when a loan's actually been closed off as well, when a new one's been started up. So one of the things obviously that the banks probably do get a little bit nervous about is when they see multiple inquiries over a very short period of time. And that's obviously when you work with a good broker, they will typically identify who that lender is going to be first before they actually put in an application and a credit inquiry is actually triggered. Whereas in the past, a lot of people used to go to all these different lenders and go, here, let us know what you can do. And then all of a sudden there's all these credit inquiries listed there. Because multiple credit inquiries in a short period of time can actually start reducing your credit score as well. So that's one downside to it. Potentially that means there's additional scrutiny from the lenders.
Yeah, it doesn't look good.
No, again, it's one of the things that we've seen in the past. Yeah, and the lenders will always come to us and go, hey, we've seen this inquiry here. Can you let us know what happened with it? And it might mean that we speak to the client, oh, yeah, by the way, we went to this lender directly and they said we couldn't get it. They've declined our application. And then you've got to explain almost to the lender as to why it was declined. And
that's why we get credit checks done before putting an application through to avoid any surprises.
Yeah. And I guess all that extra level of scrutiny that happens, or any type of queries that come up with, if your credit score gets lowered, where it might be, all it does is just slows down the whole process as well. And, typically when you're looking to buy something, you want to be able to act very fast. You want to be able to settle on it very quickly as well. Just get the deal done, really. So rather than having to go backwards and forwards, there's nothing more frustrating, not just for us brokers, but also for the clients, because the last thing you need is your broker coming in and say, by the way, the bank needs more information. They're asking this, they're asking that, whatever it might be. So it's really important, I think, to understand, like I said, if you haven't looked at your credit report in the past, do so. There's lots of free ones that are available to people. And have a look at it and see how your score stacks up. It'll give you a good indication as to how well you're doing. It's not the be-all and end-all, because some people have had lower credit scores and we've been able to, I guess, justify as to why that's happened. There might be a specific reason. Things have happened, especially coming out of COVID. That was probably a classic example where people may have struggled with certain things, but they're now back on track. So now COVID was a few years ago, so that should have all pretty much washed away by now. But definitely worthwhile looking into. So probably leads us on to, when does refinancing first actually does make sense? Did I just word that correctly? When does it actually make sense?
Yeah.
That's probably the easiest way.
Well, look, I guess we touched on briefly before, but basically if there isn't enough equity with your current lender due to a lower valuation, so we'll look at alternative lenders and get that equity released. If your rate with your current lender is a lot higher than what it should be and it's affecting servicing for your next move, then definitely time to consider. If policy doesn't work in your favor with your current lender, then definitely worth checking. Like usually people who go from PYG to self-employed or self-employed to a company, and then you just need a good policy around self-employed income. Or let's say you're a nurse and then you can, benefit from an LMI waiver with certain lenders, or you're in a certain profession. So there's many different policies around, and sometimes the bank you're with does not support your circumstances. So it can be very beneficial to move to a different lender. Sometimes we need to do restructuring, and just for tax purposes, for like setting up the next purchase and understanding what part of the equity is tax deductible, what part of the loan is not tax deductible, if you want to have an interest only component, if you want to have multiple offset accounts. So whatever that might be, then, and your current bank doesn't support it, then it can make sense to move, even though sometimes we do this, even though rates can be higher with the new lender. But as a strategy, it makes sense to make the move, even if you're paying a little bit more. But in the long run, it just helps you achieve what you're trying to achieve. So, yeah, I guess these are a few things to be aware about why it makes sense to refinance sometimes, right? It's not just about getting a better rate. It shouldn't be anyway, unless you're saving. My rule is if you're not saving at least $1,500 to $2,000 minimum per year, then it's not worth refinancing.
Good rule,
right?
Yeah, 100%. Yeah.
So
people need to be mindful. There are some costs in refinancing.
Yeah.
And unfortunately, fortunately, gone are the days where there's lender rebates for refinancing. There's. I think there might only be maybe one left in the market that I can think of that does it. So, but by all means, they're not massive costs. We're talking exit fees from lenders to registration of mortgage.
Yeah,
$500 would pretty much cover it. So,
So I guess what's the best way to approach it? What to be prepared for?
Yeah, I think instead of, and I know we touched on this briefly earlier on as well, let's just refinance now and figure out the purchase later on. Consider the following process, and that is run the full servicing, including your future purchase now. We do it quite regularly with our clients. We typically go for at the higher end from a purchase price point of view as well, so that if they purchase less, great. At least we know that if they go to that maximum level, they're going to be okay from that point of view. Compare, always stay and top up, refinance and extract, restructure both loans together at the same time. And you decide what your timing based on, I guess, the future purchase as well. So if there's auction plans going on, there might be a fixed rate expiry on the existing loan as well. You obviously need to take that into consideration as well. And personal cash flow is probably another one that you need to be mindful of as well. So, I think sometimes it's cleaner to submit a refinance and purchase simultaneously. And sometimes it's actually better to wait. The key is actually just aligning them correctly as well. And that's where getting the good advice from a broker will help you understand what's the best way to actually tackle it.
That's it.
On the flip side, what do you reckon some of the common mistakes that we see?
Well, I guess to recap quickly, some of the mistakes is, like we said, refinancing just to get a better rate. And if the savings are not much, then it makes absolutely no sense. Increasing your credit card limits or getting a car loan or getting extra debt when you're refinancing and getting ready to purchase, that can affect consolidating debts just for the sake of consolidating debts, and then you go out there and then get new bad debts. And I've seen that, and it just kills me, because it's like we've just done a massive cleanup, paid off 50, 60K off bad debt between credit cards and cars, and then they go and get a new car loan, and it's just like, far out.
Thanks for that.
Your future self is not going to thank you much, right? It doesn't affect me personally. It's just, it hurts me, right? And not factoring in lender policy, I guess, right? It's just be, like we said, intentional about what you want to do, and just bear in mind that this cost, the small difference in cost between lenders does not matter. If you're trying to do something bigger and you're planning for your future and you're trying to increase your property portfolio, then lender policy is really key, which will support you along the way. But having said that, you can always refinance to keep going forward. So, Yeah, refinancing before you buy is definitely a strategy. It's not wrong or right. It just needs to align with what you're trying to do. And if it makes sense, then yes, you should look into it. But yeah, you just need to execute it in the right way. And sometimes, yeah, if you take a misstep or make the wrong move, it can impact what your next move can be. And yeah, it will have implications in the future. So that's why we always say, reach out. We run the numbers, we run the scenarios, we tell you exactly what you can do, what you can't do, how you should do it, explain the numbers so they make sense to you and you understand the full picture, because it's not just a matter of getting the better rate every single 6 months, right? Because that is actually doing more harm than good to you. So any questions, we're always available. And yeah, any feedback, any questions, please reach out. And that's it. I don't know if you've got anything else to add.
I think we've covered pretty much most of it.
Yeah.
Good summary.
Perfect. Cool. Thanks again. And leave us a review, 5 stars. Otherwise, don't leave anything.
I love it. That's subtle.
I still love you, but just and we'll see you around, hopefully, if the world doesn't end in the next few weeks. All the best.
Take care, everyone.
Bye-bye.
Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Head to the show notes if you want to book a free call to discuss your personal situation.